Welcome to Grab the Horns. I'm Daniel Cooper. We've got a great show lined up for you today here. We're going to be looking at a stock by the name of Comcast. Let's go ahead and dive right in. We've got a good presentation here, so let's begin. So Comcast recently announced something interesting. They actually recently announced a $4.4 billion, that's billion with a B, bid for the U.S. right to carry the Olympic Games through 2020. Now, it should be noted that NBC lost more than $200 million the last time they showed the Winter Olympics. Now, this is according to the Associated Press. But, losing such a large sum of money begs the question, why would Comcast go out and place such a high bid on this? Now, part of the thinking relies on the fact that the Olympics draw such a huge crowd that networks use the Olympics to really introduce and promote their TV lineup. So this is what the thinking is behind Comcast making such a large bid to do this. In fact, Comcast CEO Brian Roberts, he also hopes that making the bid, the way to make it profitable will be to use newer technologies. Now, examples of that would be showing clips online that could also be shown as ads with an additional added revenue stream there for Comcast. So that's kind of the thinking behind what they're doing there. So that's just a quick aside on Comcast, some recent news about what they're doing. Let's go ahead and jump into the stock itself. So Comcast has two different shares. The first share is the Comcast Class A Special Common Share. Ticker symbol is CMCSK. Now, that stock there, they're generally not entitled to vote, while Class A Common Stock, CMCSA, is allowed to vote. So that's the difference between the two shares. Both of them look almost identical when it comes to their trading patterns. As we can see here, we're going to be looking at Comcast Corporation, just the Class A stock, not the special stock here. This is the CMCSA. So let's go ahead and look at this stock here. Now, Comcast, along with some of its rivals such as Time Warner Company, ticker symbol on that if you want to look it up is TWC, they've been in a 2-year uptrend. Now, this is a 2-year chart here, and as you can see, its low roughly 2 years ago is around $13. Its high, which it's coming off of about a month ago, is about $27. So even where it is today, about $23, $24 a share, it's still seen quite a jump in this last 2 years. Now, although just like other rivals such as Dish Network, ticker symbol DISH, and DirecTV, DTV, all of these stocks have reported a small loss of subscribers in recent quarters. Now, this is a bit concerning. Most of these companies have offset these losses by introducing pricier bundles. You hear on TV all the time the triple play and things like that. Bundling your home phone, which, let's admit it, most people have cell phones now, so the home phone is almost going out of place here. Bundling your home phone, though, with your TV service as well as your internet service. So they're trying to wrap people into bundles and make some money that way due to the fact that, they are losing money quarter over quarter because people don't want to pay for cable anymore. Long term, all of these stocks, Comcast, Time Warner, Dish, DirecTV, they have a serious threat with the likes of companies like Netflix, Apple TV, Hulu, and even Facebook. These companies here are offering consumers TV at their fingertips through their computer, through their TV, any way that they want, and it's going to be a whole heck of a lot cheaper. For example, Netflix, $8 to $10 a month, you can get on Netflix and you can view a lot of different TV shows that are out there, a lot of movies, just streaming them live right to your TV. Apple TV, similar type thing. You buy the box for a couple $100, plug it into your TV, and you've got access to your Netflix subscription as well as a lot of other really cool tools. Hulu records basically all the hit TVs that are out there, the last 4 or 5 episodes of them, and you can watch them for free right on Hulu.com. And even Facebook, they're testing the waters to offer their users movies, which they can view online as well. So a lot of competition right there against companies such as Comcast, DirecTV, and Dish there. In the short term, really doesn't make sense to bet against Comcast or these other companies for the simple fact that you saw the 2-year chart. They have been going up. Long term, though, Comcast as well as the others out there, they face similar challenges as the music industry did, Blockbuster, and other outdated business models. It's a concern that the heads of those companies have, and investors should have as well, because there's a lot of newer technology that's really coming in, stepping up the game. And if these companies are going to survive in the market that we're in right now, they need to reinvent themselves. They really need to strive to really catch up with technology the way it is and find a way where they can market their business with this new technology that's out there. As always, we really appreciate you watching the show. Hope you learned something today. Get out there, get on your investments, grab the horns.